You're listening to the Financial Source podcast on YouTube.
Welcome back to the Deep Dive. Today we're looking at a specific collision point where high stakes global politics crashes right into your portfolio. We've got a stack of reports covering three big zones. Japan, which is seeing, well, historic stability.
Right.
The UK, which is basically in political chaos. And the US, where the economy is finally starting to cool down.
It's a great setup. I mean, usually we see politics and economics as sort of separate lanes.
Yeah.
This week, the data shows they are just completely merging. The politicians are making the speeches, sure, but the bond and currency markets, they're the ones actually keeping score.
Okay, so let's start with Japan then, the stability player. Prime Minister Takaʻichi didn't just win, she secured 352 seats. That's the largest majority since World War II.
It's massive.
And usually a landslide like that makes markets nervous.
Right.
But equities rallied and the yen stabilized. Why?
It comes down to two words, really. Fiscal discipline. Takaʻichi's promising a food tax cut, which sounds populist, but she's funding it without issuing new deficit bonds.
So she isn't borrowing to pay for it.
Exactly. For a bond trader, that is the holy grail. It signals policy continuity, responsible spending. They love it.
But there's a massive disconnect here in the data. You have this historic political mandate, yet the household data looks grim. Real cash earnings fell by 0.1%.
And that's the critical nuance. Real earnings, so that's wages adjusted for inflation.
Okay.
Nominal wages actually went up by 2.4%, which isn't bad, but inflation just ate all of that and then some. The government was targeting a 3% wage bump, and they missed.
So the government has a supermajority, but the average worker has less purchasing power than last year. That feels like a ticking clock no matter what the stock market says.
Precisely. The stock ticker and the grocery bill are telling two different stories.
Yeah.
And if you think that's tricky, just look at the UK. If Japan is stability, the UK is pure volatility.
The reports on Labour leader Kιρ Στάρμερ are pretty stark. He's facing a huge leadership meeting, and the British pound is reacting to every single rumor.
Yeah, it's shaking. But the trading dynamic here is, it's almost counterintuitive. Well, the pound is softening right now because markets hate uncertainty. But the strange thing is the consensus on trading desks is that if Starmer resigns, we might actually see the pound spike.
A relief rally on political chaos.
In the short term, yes. It just removes the will he, won't he drag on the market. Traders are bracing for some really sharp intraday moves. I mean, if you're holding sterling, you're trading headlines this week, not fundamentals.
Speaking of fundamentals, let's pivot to the U.S. The White House just downgraded its GDP forecast from 5% to 4.45%. Still strong, but a clear signal the engine's slowing.
It is. It's that soft landing scenario playing out. But the real headline grabber in these notes is the Federal Reserve's timeline. They're signaling they are open to rate cuts, but probably not until 2026.
2026. Wow. That forces investors to completely rethink things, doesn't it? If rates stay high for that long, cash is expensive.
That is the risk. The Fed's playing a long game here. They are laser focused on one thing: labor market deterioration.
So they won't cut rates until they see cracks in employment.
Not a chance. And that's why this Wednesday's non-farm payrolls report is basically the only data point that matters right now.
Because if that jobs number cracks, that 2026 timeline just evaporates.
Instantly. Bad news for workers would ironically be very good news for anyone hoping for lower interest rates.
Okay, before we wrap up, we have to talk about this small, almost hidden detail in the geopolitical section. Peace talks for Ukraine, targeted for March. Iran tensions are stable, but there's a whisper about a Fed Treasury Accord.
I'm glad you caught that. It sounds so boring and bureaucratic, but it's actually explosive.
Because it implies the line between the politicians, the Treasury, and the central bank. The Fed is blurring, right?
Exactly. Central bank independence is a pillar of modern economics. If there's an accord, it usually means the central bank is agreeing to keep rates low to help the government fund its debt, not to fight inflation.
Which just changes the rules of the game entirely.
It does. If interest rates start serving political agendas rather than economic data, all those forecasts we just talked about, you can just throw them out the window.
Something to keep in the back of your mind as you watch the tickers. Japan has wage issues, the UK has leadership risk, and the US is testing the brakes. Thanks for listening, and we'll catch you on the next Deep Dive.